makers and market movers. This is The Pulse with Francine Lacqua.
It's me, Guy Johnson, this morning. No Francine. She's out for the day. But we've got a great guest lineup and plenty of things that we need to be discussing. Let's kick things off with trade, which I think is going to be a story that's going to develop throughout this week as we head towards the 1st of August or potentially the 6th of August, a little further down the road in terms of the European response. European envoys potentially set to meet over the next few days to formulate a plan basically to put forward measures to respond to a no-deal scenario with the United States with US President Donald Trump. The US is now seen to want a near universal tariff on EU goods that could be higher than 10%. But US Commerce Secretary Howard Lutnick says he believes a deal with Europe can still happen.
I am confident we'll get a deal done, okay? And it will be great for America because the president has the back of America. So I think all these key countries will figure out it is better to open their markets to the United States of America than to pay a significant tariff.
Howard Lutnick, let's talk to Bloomberg's trade czar, Brendan Murray, who joins us around the table. Brendan, the market's become very complacent about the risk coming through from trade. The EU feels like it's now it's sort of waking up to the risk that actually a no-deal scenario is now possible. The market's yet to get there. How big a risk is there here?
Well, I think it's a growing risk. I don't know how big it is yet, but it's heading in the direction of riskier in terms of the economic fallout that this could create. The important thing that Howard Lutnick said right there was it's going to be great for America. The flip side of that is it's not going to be great for the European Union. So officials in Brussels are going to get together and try to figure out how much pain can we actually take. What is the threshold of that reciprocal tariff? 10% would be, they would take 10%, they could absorb that, but 30%, the way it's proposed right now, is going to cut off trade significantly between the two trading partners. So the real question now is, we've seen a lot of deals come along, talks of deals, frameworks, and various sorts of arrangements toward the deals that Donald Trump wants to get together, but we haven't seen any real retaliation. And the Europeans are threatening what would be the first significant kind of retaliation if it gets to that point.
It's interesting. We're all focusing on what is happening across the Atlantic, but in reality as well, we need to focus on what is happening with the relationship with China too. We've got this EU-China summit coming up later on this week, and it now looks as if we're going to see a Trump-Xi summit as well on the fringes of the APEC summit. What do we know about all of this and how that side of the relationship is going to develop?
Well, the European relationship with China is also not in a great place right now. They've had a number of sort of back and forths on various issues. The meeting this week in Beijing will be an attempt to try to put that back on track and to try to show that the two sides can work together as strategic, sort of allies and competitors. But the three economies are in a difficult position right now, and they're all trying to jockey around to figure out who is really going to be, who has the leverage in all of these different negotiations.
Brendan, great stuff. Thank you very much indeed. Brendan Murray on what is happening with the trade story. We're going to be gathering momentum as we head towards the back end of this week, I suspect, and that story is going to be front and centre. The story that is front and centre this morning is what is happening out in Japan. The Prime Minister has insisted that he will stay on, despite his ruling coalition losing its majority in the upper house. Remember that Prime Minister Ishiba has now lost the lower house and the upper house. Haven't seen that since, I think, the mid-50s. Anyway, this is also going to complicate matters when it comes to trade talks. Ishiba insisting that actually there will be no impact on that, but that's hard to see with this political instability. And it's unclear kind of what happens in terms of meeting the US president. Remember, we've had the US Treasury Secretary in Japan as well. So what happens next is going to be key. Let's take a listen to what he had to say on that matter.
We must protect Japan's interest in trade talks with the U.S., keeping in mind the deadline of August 1st. I have passed this message to U.S. Secretary Bessent when he recently visited. Akazawa will be visiting the U.S. from today, and I hope to show tangible results in trade talks soon.
Let's talk about the implications of all of this. Alice French joins us out of Tokyo. Alice, Ishiba is implying that he needs to continue with these trade talks. Japanese markets are closed today. do we have a sense that maybe actually things have got more complicated, and we're going to get a greater sense of that tomorrow when markets reopen?
Morning. Yeah, like you say, I mean, things are basically just even more unclear now than they were before. We actually saw the yen strengthening slightly today, I think partly on that sort of safe haven demand amongst all of this uncertainty, and also because the yen had already weakened quite a lot last week on worries around this election. Like you say, trade is going to be a big focus here. I think, election or no election, the talks hadn't really yielded any concrete deals so far. So there's already a lot of uncertainty and worries around that. And now a lot of people I've been speaking to here today saying that it looks even less likely that Japan will be able to get a positive deal now that Ishiba has been weakened domestically. Like you say, obviously, equities trading is closed today, but tomorrow I think kind of those trade-sensitive sectors, things like big exporters, automakers, are really going to be in focus in terms of, where investors are going to be looking to put their money, and they may be the ones that lose out on this.
What is the fear here? Is it that we see more uncertainty? Is it that maybe we don't see rate hikes coming through from the BOJ in the way that we had anticipated? What is the threat that emanates from this election, from the fact that the LDP, for the first time since the 50s, no longer controls both houses?
Yeah, like you say, I mean, it's basically just this general uncertainty about where do we go from here in terms of policy, right? Fiscal policy, for example, we know that Japan has a huge government debt burden, more than 200% of GDP, and there have been worries around government spending and what Ishiba is going to be able to do about that now that he's weakened. We know that opposition parties have obviously bolstered their influence in the upper house. Several of them are asking for tax cuts to the consumption tax. How is that going to be funded? How will Ishiba be able to push forward with his plans for increasing defense spending if government spending plans are changed? And then, like you say, obviously trade, and the BOJ is looming all over this, right? We know that if there's going to be less certainty around policy, they may be more cautious with their future rate hikes. I think in general that the consensus is that the BOJ will have to push forward with those hikes at some point, but this election outcome may slow down the pace of that, and for some investors that's going to be bad news.
Alice, yep, we're going to watch tomorrow with a great deal of interest to see how this all fits together once all these markets open. Alice French joining us out of Tokyo. Aneka, Beneby, portfolio manager at Julius, Baer, joined me around the table this morning to think about all of this. Good morning.
Good morning.
Uncertainty, just more uncertainty. Japan is creating more uncertainty. You've got the trade story looming. We don't know what's going to happen there. It feels like a bigger threat than maybe the market is looking for at the moment. Yet, asset prices look good. Markets have rallied. The market seems very calm. Is that the right place to be right now? Is this still a glass half full kind of environment?
Yeah, good observation. So we've seen this interplay between markets and investors being worried about top-down factors, those that you mentioned, tariffs, trade, inflation.
Yep.
But on the other hand, markets have been driven by bottom-up factors. The fact that consumers still seem very healthy, the fact that business sentiment has improved and business activity is increased. If you look at, what's going on with the earnings in the U.S. So what I suspect will happen is once we get some more clarity on the top-down factors, markets will continue to be driven by those bottom-up factors. And I think where we are with especially equity markets in the U.S. is we're approaching the final stages of an equity bull market that's been somewhat extended by Trump's U-turn on tariffs,
yep.
The One Big Beautiful bill as well. And because we feel we're in this, the final phase, we're actually diversifying our exposure away from the U.S. into other markets, including India, Japan, and Europe.
Okay, two things to unpack there. The final phase of a bull market. What happens when that bull market comes to an end?
Well, it could be extended for quite some time.
Right.
Obviously,
the final phase could be the end of it could be a way away.
It could be a way away. And what we've been seeing is that U.S. secular outperformance has been driven by, of course, the Mag 7, the AI theme,
yep.
which, could go on for some time. Now, and we see these results coming out, some of them this week. Now, what we see going forward is that we're going to start needing to see these companies monetize all of the capex spending that they've been doing. And we estimate that by 2027, if we don't see that, then we could get that derating the end of that secular bull market.
The corporate earnings story has yet to really reflect, but we're starting to see it.
Yeah.
The tariff story. Is this the last set of earnings you think that will be largely unaffected by tariffs? Do you think we start to see, when we get to the third quarter, that actually some of these numbers are looking a little bit more bleak? Are corporate earnings, the bottom-up story, really going to continue in the vein that they are at the moment? Because, as you say, this earnings season so far looks pretty good.
Yeah, so far so good. So let's unpack a little bit what's been happening so far with the U.S. earnings. So far so good. We went into this earnings season with quite low expectations. EPS growth expected to be around 5%. We're looking at early beats already. The U.S. banks have called out that the consumer is healthy. They're not stressed by any sort of credit factors. Business activity is doing well, especially in investment banking. CEOs are looking through any uncertainty to get deals done. And this backs up the data on the consumer as well, with retail sales, retail with wage growth also. Yep. On the tariff front, we have not seen that come through yet, like you mentioned, but we're not quite out of the woods just yet. Remember that the U.S. has still only signed deals with a few countries, and a lot of that tariff exposure that's come through, only 30 to 40% of that has been passed on to the end consumer. Going into the second half of the year, businesses may be less generous as margins start to bite. So we could actually see a slowdown in Q3, higher tariffs, higher inflation. And this is why the Fed, I believe, is justified in holding rates where they are for now.
You said you wanted to diversify away from the United States.
That's right.
Last 3 months, U.S. markets have outperformed. Why do I want to diversify away from a market that is outperforming? And as you say, yeah, we're in the final phases, but that final phase could last a long time. And my experience of the end of a bull market is that it's the last phase generally where you generate quite a lot of the upside. I appreciate these markets have already generated a lot of upside, but it is normally the last phase where you see that final kind of acceleration.
That's right. So just a bit of a nuance there. We're still very much focused on U.S. companies that we deem exceptional. Right. And certainly those are the companies that are most closely related to the AI theme. So we want to have those. Elsewhere, where we can find similar companies, we're diversifying to Europe, India, China, because valuations are better. And even though the U.S. has done better in the last couple of months, there's still a huge dispersion in terms of performance between, let's say, Europe and the U.S. In Europe, for example, the businesses are, committing to investment. Yep. We're seeing talks about deregulation. All of this is business conducive. We think that all of the infrastructure spending is going to create domestic demand as well. So really, it's fertile ground for investment in European stocks.
Are we confident that if the U.S. markets if the U.S. market rolls over, how diversified will these other markets be? What are the correlations going to look like? It feels like correlations are starting to break down a little bit at the moment, but do they tighten up if we do see the U.S. rolling over?
Could be. It could be. I think that's where, you want to have geographic diversification beyond Europe, right? So markets that we're looking at include India, China. For us, India is a fantastic growth story. You have the demographic growth story there where the middle class is expected to continue to grow and fund domestic demand, domestic equity exposure as well. That's quite low. It's only 5% or so. You have a pro-growth government as well. They are cutting taxes, increasing spending. And let's remember that the Indian market is also quite domestically focused. So it's not as exposed to, say, factors like the U.S., like Europe, for a global growth slowdown. So that's where you want to get that kind of diversification to reduce those correlations.
Great to see you. Thank you very much indeed for stopping by and seeing us. Aneka Beneby, Portfolio Manager, joining us from Julius Baer. OK, what are we going to talk about next? We're going to look at the outlook for emerging markets. Phoenix Kalen from SocGen is going to be joining us. We'll get her take on what is happening with the yen as well. Busy week coming up, lots to discuss. We'll do it next. This is Bloomberg. Welcome back. 90 minutes past the hour. Let's talk about what's happening in the currency markets around the world. The yen recouping some of last week's losses. This as Japan's Prime Minister vowed to stay in power, given he's just suffered a huge defeat in this weekend's upper house election. The LDP no longer controls the upper or the lower house in Japan. I don't think we've seen that, well, since the LDP was created back in the 50s. Phoenix Kalen, head of emerging market research at SocGen, corporate investment banking, joining me around the table. Not really your bag. But how do is the yen trade a safe haven trade? Is it a risk trade? I'm just kind of wondering how you see it right now. More uncertainty in Japan. Do I buy the yen because actually it sold off recently, or do I buy the yen because actually when things get tough, you used to go to the dollar, but increasingly now you go to the yen?
Yeah, I think it's still broadly classified within kind of the space as the euro. Safe haven, benefiting from flows away from the U.S.,
yep.
And we certainly had better than expected outcomes from the elections. So that's provided a bit of a bid back to the yen.
I've been on vacation for a couple of weeks. During that time, the dollar's had a little bit of a comeback.
Yes, about 2%.
Yeah, it's reasonable. Is it solid? Is this something that continues, or is this something that you can just chalk up to maybe the middle of the summer and nothing really going on?
So, I mean, we've got August 1st coming up. That's
Yep.
the deadline for a lot of these negotiations. Let's see if we get another extension. But there is going to be, I think, a little bit of nervousness, volatility, especially now that we're in kind of this summer illiquid period of the markets. So I think it can be a little bit choppy, and we can see a bit further give back in terms of EM currency and fixed income performance in that lead up to August 1st. And but after that, I think the question is around, how much repricing further we see out of the Fed in terms of the rate cuts that are priced in. So
you see quite a bit. So you still only got one, right?
Yeah. So we think there's only one cut coming up from the Fed in December. And that means basically that there's still about 20 basis points worth of repricing that needs to come out. And that can provide a little bit more juice to this dollar trade. And then the positioning side is still quite unfavorable for EM currencies to outperform in this space, because people have gotten so kind of bullish on EM versus on the dollar. The consensual view around dollar has been much more bearish over the past couple of months. And so I think that kind of sentiment and positioning has been unfavorable for this kind of illiquid market conditions.
Does vol pick up? Does volatility pick up?
So vol has struggled to pick up.
Oh, that's amazing.
No, yeah. So, I mean, we've tried to look at stuff like, trying to go long EM vol in certain trades, but it hasn't really worked out. Even beginning of last week, when you had kind of a 0.2, 0.3 kind of vol pickup in the really impacted markets like Brazil, Mex, Colombia, Chile, it struggled to hold those levels.
So why is that happening?
So I think fundamentally investors are still very bullish, the kind of outside US story, the diversification story. And even though the flows have been structurally quite slow to kind of materialize, they are happening. We are seeing kind of more interest in Asian investors investing in Europe EM, in Europe DM as well, in LATAM, lots of flows into LATAM. And on the flow side, we've seen a quadrupling of flows into emerging markets portfolio debt in June. So quadrupled from the April and May figures after kind of that Liberation Day chaos.
But it feels really stable. Yeah, we had the chaos, but now we're in kind of this. Does that crack at some? Does August the 1st crack that? Do we start to see greater nuance being applied to different markets as well? Does inter EM pick up more in terms of the volatility? I feel like we're in this kind of incredible environment where everybody's super calm, or it appears that everybody's super calm on the surface, and I can't believe that that's not going to change.
Well, so, I mean, in terms of the market's disbelief in kind of the August 1st deadline, I think some element of that is quite credible, because you've got lots of legal issues around some of the tariffs as well, kind of the IEEPA and reciprocal type tariffs. They are facing lots of legal challenges. The more credible ones are the sectoral ones, and I think the market does lend a bit more credence to that and does weigh on those economies more in terms of, the places where autos are being targeted or copper is being targeted, you see a more sustained impact. So I think there is definitely a differentiation between the types of tariffs that are being levied.
So you think a more nuanced picture starts to emerge?
Yes, and then, August 1st, that's 10 days away. We're not going to get that many deals done, and it's all kind of types of memorandums of understanding, just very high-level pacts. So the details won't be worked out for months, if not years, actually.
So what do we do? What do I...
So fundamentally, I think the outlook is still very favorable for emerging markets if you're looking at kind of the growth and inflation backdrop. So global growth decelerating a bit. China data getting a little bit weaker. They are in need of much more stimulus in the second half of this year for them to kind of meet those growth targets for this year. And then inflation side, we're seeing a pickup in the U.S., but we're not seeing a pickup elsewhere. And so,
is it inflationary in the States, deflationary elsewhere? Is that a reasonable kind of way of painting this?
Well, that's what's actually been happening, and we are actually seeing some deflation creep back into the China data as well. So, excess supply is a big problem for the rest of the world versus for the U.S. So I think there is that kind of component of deflation creeping through, or disinflation creeping through to the rest of the world. And then I think in terms of what EM really worries about is a real rate shock out of the U.S. And despite the move that we've had, kind of a 25 basis point move across the curve in the past 2 weeks, that's not a real rate shock. That's been driven mostly by rising inflation expectations. So 5-year break-evens, that's gone up 24 basis points in the past 2 weeks. So pretty much matching the nominal rise that you saw in U.S. rates. So I think that's really the story behind that move. And so investors on the EM side really shouldn't be concerned about that because that's not a real rate shock. We still have very favorable kind of real components on EM, on the growth and inflation fund.
So which currencies am I looking at? Where am I going to see the outperformance?
So we still love LATAM currencies. So we've got on a basket trade, which I think is a good way to diversify when you've got lots of risks coming out of the Trump administration about how they might target individual economies. So we've got a basket trade where it's long, equal-weighted Brazil, Mex, Colombia, and Chile against the dollar, so short dollar. And that's been able to withstand this kind of market volatility. I think that's one good way to kind of think about thematic themes that are maybe less favorable for the U.S. and more favorable for the rest of the world, but do it in basket kinds of expressions. We've been trying to look at long vol. It hasn't really worked out well yet. We still like other short dollar positions, like short dollar versus CEE. And then I think after this little bit of market wobble in the summer period, we would be looking into receiver positions in places like Brazil, South Africa.
Looking forward to seeing some of those trades maybe working out. Felix, nice to see you. Always great to see you stopping by. Felix Kalen, Head of Emerging Market Research at SocGen Corporate Investment Banking. Coming up, we're going to turn our attention to what is happening in Germany. Germany's biggest companies pledging hundreds of billions of dollars in investment. We're going to talk about that next. This is Bloomberg. Morning. Welcome to The Pulse. I'm Guy Johnson in London. Let's talk about your top stories this morning. The Japanese Prime Minister vowing to stay on despite a historic election setback that saw his ruling coalition lose its majority in the upper house. They don't control the upper or the lower house now, which is the first time that's happened since the mid-50s. EU officials are set to meet in the coming days to plot a possible no-deal scenario with the US on trade. Washington very much hardening its stance on tariffs over the last few days. Plus, Ryanair, its stock rocketing this morning. Stellantis stalling. We'll give you a key roundup of some of the stories that you need to be watching on the corporate front in just a moment. But let's turn our attention now to what has been happening in Germany this morning. Dozens of Germany's biggest companies have joined the government to launch a new investment drive worth at least 100 billion euros. Deutsche Bank and Siemens are amongst those companies that are leading this investment alliance. The objective here is simple: to revive Europe's biggest economy.
I think it's quite impressive what we have collected after a couple of months with over 600 billion of investments, 61 companies. And to be honest, I think more to come over the next months. But it shows what the sentiment is and that we have a chance.
The Deutsche Bank CEO, Christian Sewing, speaking to Bloomberg's Ollie Crook a little bit earlier on. Ollie joins us now out of Berlin. Ollie, talk to us about what is happening here. This is the corporate story in Germany coming forward and saying, we want to invest, we're going to take your leadership and we're going to follow it up. Talk to us a little bit about kind of the scale and the intent and how far this could ultimately go.
Yeah, so this is an initiative that was really spearheaded by both Roland Busch, the CEO of Siemens, and Christian Sewing, the CEO of Deutsche Bank, to really come together, this sort of initiative called Made in Germany, to try to get these companies to pledge money to invest in Europe, to invest specifically in Germany. Because, Guy, as we know, there's the amendment to the debt brake. There's all the spending that's going to happen in Germany from the government level on defense and infrastructure. That could be more than €1 trillion. But at the end of the day, that's only worth so much. That can drive things only so far forward. What you need is the private investment. So this is more than €500 billion worth of investment. I mean, they are saying that this is not really sort of Trump level accounting. This is sober German accounting. You know, Trump says, you know, there have been $14 trillion worth of commitments made to the United States. There's some question about the veracity of those claims, but that is the sort of moment of opportunity here for Germany. There is, however, also, Guy, the risks also on the horizon, namely that of the trade war and tariffs, and that could potentially blow things off course. Have a listen to what Roland Busch, the CEO of Siemens, had to say about the threat of tariffs here in Germany.
There's one point which is super relevant is we have to stop this uncertainty. So once there's a deal, the deal should be the deal. And then we can deploy capital again based on facts.
And when we were speaking a little bit before the interview, you know, he was saying that basically an okay deal on trade in the next couple of weeks, you know, even if it's not the best deal, is going to be better than another 12 months of negotiations and sort of paralysis on this question of tariffs, because companies can begin to actually make decisions. It's something we hear from a number of different companies. There is, however, not just the risk associated with what the United States is doing. There's also an opportunity there. And that I got from Christian Sewing, the CEO of Deutsche Bank, in appraising kind of this sell America, buy Europe trade. Have a listen to what he had to say.
There is one trend which is the same across the world, that our clients want to have a European alternative to the US banks. Mm-hmm. We have very strong US banks, very capable US banks. But in this world of geopolitical uncertainties, they want to have a capable global European player.
So in the sort of vast balance of risks and opportunities that are facing the German economy right now, you know, this initiative is really something that's being driven by the German private sector in trying to capitalize to some of the momentum that we're getting here from the German side, really getting buy-in from the political side, the private business community very happy with what they're seeing with the government amid the risks that are also on the horizon, and really just trying to insulate the German economy and trying to really reimagine it, Guy, for what it looks like the next 10, 20 years from now. It's going to be very, very different from what it was in the last few decades and what really drove wealth in Germany over the last 50 or so years.
Ollie, great stuff. Thank you very much indeed. Really enjoyed the interview. Thanks very much indeed for updating on the takeaways from it. Let's carry on the conversation around this infrastructure story. Philippe Chryssicopoulos, a global co-head of Global Industrials Group and global head of infrastructure and power at UBS, joining me around the table. Perfect person to pick up on what we've just been hearing about. Good morning.
Thank you very much for having me.
Is this a German story or is this a European story? It's the first question I want to ask, because I hear a lot about Germany at the moment. I hear about the investment that German corporates want to make. If I go across the border into France, it feels like a very different narrative. So are we confusing at the moment a big German investment drive with a European story that looks more positive? How nuanced do we need to be here?
The reality is today, on the back of the European Union, when you think of the big engine rooms, Germany has always been one of the key factors. And so it's sometimes difficult to completely separate Germany from the rest of Europe. But I do think that Germany will be the driver of this change, and it will affect overall momentum across Europe.
This is a conversation that we're having at the moment between German corporates. Ollie was talking to Siemens and Deutsche earlier on, and the German government. Yet there's also this kind of broader pull by European corporates. And the message they're sending to Brussels is, come on, get on with this. We've had the Draghi report. We've got all this other stuff going on. We need to act, and we need to act boldly. Is what we've seen so far Europe acting boldly? Is there more bold action still to come?
So interestingly, I think Europe has always managed to thrive in times of crisis.
Yeah.
You know, in a benign environment, they seem to not make big decisions.
Yeah.
I'd like to think that this is a beginning of a bigger shift, and the German headlines will clearly be critical in pushing the European shift. What's interesting about the European headlines is it's largely focused on aerospace and defense and the infrastructure space as well. And it's not uncommon for governments to use infrastructure as a way of resetting, of propelling their economy. Infrastructure has multiplier effects, whether it's called labor, whether it's called supply, improved efficiencies. And so the German government is focusing on that. And I think Europe, has made similar headlines, much smaller.
Yeah.
I think the difference with Germany is the scale at which it's happening. And it's clearly creating a shift in how investors on the private markets are going to look at this opportunity.
Where are the opportunities? Because what I still hear from corporates in Europe is still too much bureaucracy. Still, that's a problem. Europe needs to deal with that. But the other thing I hear a lot about is still energy. And where do you think, outside of defence, that the opportunities lies? Is it about reducing Europe's energy costs? Where is the big opportunity still that exists that gets Europe into a position where it can thrive in a much more self-sustaining, positive way?
So the headline is infrastructure. If you break down infrastructure is not just about bridges, roads, and rail.
Yep.
Infrastructure today is much broader. It includes AI and creating the right infrastructure with data centers.
Sure.
It means electrification, EV charging, but also the need for power to power these data centers.
Yep.
Energy independence. These are massive, these are real mega trends that are cutting across Europe and across the globe today. And so the needs are significant. And you see capital coming in to fill these needs. The infrastructure funds today are some of the largest players in private capital markets.
How much further do we have to go? How much more capital is required? Where are the bottlenecks? Because you can push capital into a market, but sometimes it gets stuck, and you end up with it being applied in the wrong places. Where do you see where is the challenge right now? Because actually, what it doesn't feel like at the moment is that the problem is availability of capital. It feels like it's actually executing, pushing that capital into the right places.
I actually think that's absolutely right. You need a pull and you need a push. And right now what you're seeing is they're trying to create the pull. These headlines are effectively trying to incentivize private capital to come alongside the government to fund investments, both in defense, but also, importantly, in the broader infrastructure space. The push needs to have the right incentives and the right platform to do that. I think there's work that's required there to make that investment easier or to make the barriers less difficult.
Yeah.
But I think Germany is making, more than just a big number. They seem to be creating an investment through a setup that will allow private investment to come alongside it, whether as co-investment or as government guarantees that might be coming to incentivize the private investment. So I think they are creating the right backdrop. But how is that going to translate into M&A? I think that's still TBD. I have no doubt it will translate into an increased M&A activity around the infrastructure space more broadly in Germany.
So do we get bigger, stronger companies? Is that the net result of all of this?
We'll get a better infrastructure backdrop over the next decades, or more, and that's a necessity. We cannot remain the way we are, and when you look at, again, in data centers, just in AI, there's over $1 trillion of investment required over the next 5 years.
Yeah.
That's massive. In the capital around electricity, the same thing. Power has been flat for the last decade, power generation and power demand. It's increasing now, and it will increase even more going into the future. All of these things will only happen if you put capital in. And infrastructure funds today have massive amount of capital to invest in these assets.
But I still hear about the bureaucracy. I still hear that it's a challenge to get it done here. That yes, the money is coming in, but executing on the platforms and the projects is still difficult. Trying to get stuff done is still difficult. Are we moving fast enough in cutting the barriers, the red tape, to getting some of these deals done at a time when Europe has this determination to do more, but seems to be just tripping over itself in terms of executing on that?
We never move fast enough.
No.
Across a broader infrastructure space and across removing the red tape. So the short answer is we can do and we should be doing a lot more to improve and facilitate the capital deployment. But again, these headlines I would like to think will help also Europe move in a direction of removing that red tape to allow for infrastructure funds to deploy capital in this space. And that's a necessity.
How long a trend is this going to be? Like, how long does this last? Because Europe historically has this kind of, Europe gets on the front foot, but it doesn't last very long. Is this, you talk about mega trends, is this a trend that is sustainable?
Absolutely. Again, if you think about the underlying mega trends, these are things that are imperative to happen. It's not a good to have.
Yep.
It's a must have. And therefore, when you look at the future, it will undoubtedly happen, and it will have to happen in a very short term. As I said, AI, electrification, but even our own airports here in London, same thing. Right?
Yep.
So there's a need for capital that needs to happen quickly.
Philippe, great to see you. Thanks for stopping by to see us. Really appreciate it. Perfect timing. Chryssicopoulos joining us, Global Head of the Global Industrials Group and Global Head of Infrastructure Power at UBS. Let's talk about some of the other stories we're watching right now. Israel has warned it will move for the first time into a town in the heart of the Gaza Strip that had earlier skirted for fear of harming hostages. The military on Sunday told Palestinians to evacuate southwards away from the area. Officials in Gaza say a total of almost 1,000 Palestinians have now been killed while waiting for aid, including 67 Sunday. Witnesses said Israeli tanks fired shells towards Palestinians awaiting the entry of food trucks in northern Gaza, an area that has seen intense clashes with Hamas holdouts. The Washington Post is reporting that a Chinese-American employee of the U.S. Commerce Department has been barred from leaving China since April. According to the South China Morning Post, he travelled there to visit family and was detained when he arrived in the city of Chengdu. The Washington Post cites sources saying the man is being held because his case is linked to actions Beijing considers harmful to national security. And hackers are reportedly said to have exploited a major security flaw in a widely used Microsoft Server software platform to launch a global attack on government agencies and businesses in the past few days. According to the Washington Post, the US is amongst countries investigating the compromise of the SharePoint servers, which provide a platform for sharing and managing documents. Coming up, we'll talk about what is happening in the aviation sector. Profits at Ryanair have more than doubled in the first quarter. This is the airline says it's recovering from last year's drop in fares. More to come on that story shortly. This is Bloomberg.
People are very keen to get out and about and travel. We've 2,600 different routes across the network, including 160 new routes this summer. All of those are booking very strongly. Fares are recovering nicely. We would expect to recover almost all of the 7% fare decline that we had in the second quarter last year. So, you know, we're seeing no softness in people who want to travel. We have limited growth this year. We're only growing by 3% to 206 million passengers. But demand is exceptionally high, and we've no qualms about hitting that target this year.
CFO of Ryanair, Neil Soren, speaking a little earlier to Bloomberg, Europe's biggest budget airline, reporting a doubling of net income in the first quarter. Strong numbers. Actually, the share price reaction has been very strong as well this morning. Let's bring in Bloomberg's managing editor for global aerospace and defence coverage, Benedict Camel. Benny, let's start and talk a little bit about Ryanair and what we're getting this morning. The market clearly very pleased with what we're hearing. This is in some ways a capacity-constrained airline. We're also seeing capacity constraints elsewhere in Europe. Is that why maybe we're seeing a bounce back in the numbers that we're getting right now?
Yes, this is a really good market for Ryanair to be in. This is a market for frugal travellers. We're heading into the summer period. People want to get out. And as you say, we are capacity constrained. We're capacity constrained among the rivals. EasyJet's having issues. Wizz Air's having issues. So that really helps Ryanair. They did have a tough spot over the last year with the intake of their Boeing aircraft. That seems to be behind them. We heard from the CFO this morning. He said he's very happy with how things are progressing at Boeing. We're 1 year into the new CEO tenure of Kelly Ortberg, and it feels like he has managed to turn things around. There's a better cadence, a better tempo in terms of the aircraft that they're delivering to customers, and that includes Ryanair, of course, which is their biggest customer in Europe, to a point where they say We still have aircraft coming next year, but we don't have to take them necessarily. We're in a good place right now. So all of that is really helping the airline right now and the outlook.
You do kind of wonder, and the share price maybe reflects this morning, that actually the lack of capacity, the lack of aircraft that has come out of Seattle has helped in terms of their ability to bounce back from that fare dip. And the market was really shocked, what was it, 6 months, 9 months, a year ago, when Ryanair came out and said, actually, we're seeing some softness in fares. That seems to be firmly in the rearview mirror.
Yes, you're right. So the situation coming out of Boeing is looking much better. The situation over here is also good for Ryanair. So the fares are creeping up again. That's a good picture. But capacity remains under control to a point where they can really manage that. The demand into Southern Europe remains strong. Into Scandinavia, we're hearing that's really going very well. They've pushed extra capacity and extra routes into Scandinavia. They're sort of going after some of the areas that they feel are conducive to their business model, so low cost, low taxes. Germany is not one of those places. Germany is actually one of the markets that's not really doing very well for Ryanair, but they have options to go elsewhere, and they're really pushing that.
The first headline I read this morning was the fact that Alaska, over in the United States, Alaska Airlines had a ground stop this morning. It looked like it was an IT issue. What do we know about that?
So that seems to be it. It seems to be that the IT issue is now behind them. But the bigger picture really is how creaky is the software in the US aviation market in particular. It's something we've seen routinely over the years. It's sort of this rolling issue. Usually they manage to get over it fairly quickly, but Alaska Air has been hit by this several times now. There's also been IT hacks. So all of that raises the question, like, what kind of an upgrade does the system need, both at the airlines proper but also on the ATC side? We know the US government is trying to do something about it. The new bill allocates quite a lot of money towards upgrading the system, but these things take time. And then what you see is what we had at Alaska, thankfully fairly short-lived, but it's a reminder that this is a system that's often been sort of patched together over the years, and to renew it costs a lot of money, it can cost time, and then you have these issues.
Benny, thanks very much indeed. Benedict Camel, Managing Editor for Global Aerospace and Defence Coverage here at Bloomberg. Let's go from planes to cars. Stellantis reporting a $2.3 billion net loss in the first half as restructuring expenses, falling sales and US tariffs hit the struggling automaker. Craig Trudell here to talk about that. New CEO. I kind of read the statement this morning and you kind of look through it and you're thinking this feels like a CEO that's come in, looked at the numbers, said, right, let's clear the decks, figure out where we go from here.
Yeah, more than a few analysts we've seen refer to this as a bit of a kitchen sinking on the part of Antonio Filosa. He does, of course, have a lot of issues to work through that he inherited from Carlos Tavares, who the board moved out of his role late last year. And I think this is a reflection of a company that was without a CEO for much of the first half. It is really sort of lost from a perspective of where they are with their lineup. They were trying to make this pivot and this change to electric vehicles with a lot of brands that doesn't really jive very well with or easily with in terms of Ram trucks and Jeep SUVs. So some of this 3.3 billion euro charge that we saw the company report this morning has to do with canceling programs. What I think we may see, given where fuel economy standards are going in the U.S., is sort of bringing back Hemi engines, bringing back some of the gas guzzlers that the company can now sort of get away with bringing back into the fold and sort of put off having to make that electric transition.
Okay, let's talk about what else we've got on deck this week. Talking of electric transitions, let's talk Tesla. What is the bigger picture that is emerging from the also story? We got Volkswagen as well this Friday. I think they're out with numbers. What's the bigger picture we're looking at?
Yeah, I mean, I think the implications of this federal pullback in the U.S. is really going to be far-reaching. Where you would think on the surface it would help a company like Stellantis, and yet they were spending all of this money to bring electric vehicles to market, investing in batteries. With Tesla, you have a very different story where they were really able to sort of benefit from the fact that these rules were getting tougher. Established manufacturers were having trouble making this change. Now, sort of the pressure is off these companies. The regulatory credits that they used to have to buy from Tesla, they no longer may need to buy any at all, or at least as much. And so just how much that's a real issue for Tesla going forward. Given the fact that over the years they've earned something like $12 billion in revenue that has been, out of the pockets of their competitors and into
it's amazing. Every time you look through the numbers and you see that figure, you're like, how on earth is this possible? And are you making cars or are you just doing credits? It does sometimes feel like that. Craig, thank you very much indeed. Our Autos editor, Craig Trudell. Let's talk about the other sector that we're going to be spending a lot of time talking about this week, and that is going to be the European banking sector. We've got a series of numbers coming up over the next few days. Chloe Melly joins us to talk about that. Deutsche first. Let's talk about Deutsche. What are we expecting there?
Yeah, so the CEO has said a few things recently that we need to kind of keep in mind going into the results on Thursday. So he said just today that companies and individuals, amid all the kind of tariff uncertainty, were trying to seek an alternative to US banks and really refocusing on European banking. So we'll see how much that kind of feeds through and is reflected in earnings. At the same time, he also said recently that there had been quite a rocky start in the trading business at the start of the second quarter, and also weaker than expected performance in the advisory business. So based on all of that, it seems like there might be some disappointment with numbers, but some bright spots, including particularly in the corporate bank we expect.
What other banks are we going to be watching?
So we're looking for BNP Paribas also later this week, and NatWest and Lloyds, and then we have a few others next week coming through. The main thing to look out for this particular season is that after quite a resilient first quarter, we expect the second quarter will be a bit tougher. So obviously we've got the trade war, we've got recession fears, interest rate cuts. All of that is feeding through into lower net interest income. We've already seen that with Nordic banks. A higher cost of risk. It's also impacting deal making. So all of that we're kind of keeping an eye on. The read across from US banks shows that maybe there might be a bright spot with banks in Europe that have a really strong investment banking division, like BNP, SocGen, Barclays next week as well. And then UK banks, Lloyds and NatWest, might be doing a little bit better than their peers because they have structural hedges that kind of protect them from the impact of rate cuts. So they're kind of shielded a little bit better.
Chloe, great stuff. Plenty to look forward to as we watch what's going to be happening with the bank reporting season. We'll bring you all those numbers, of course, as we work our way through that over, the next 10 days or so. Quick look at what is happening with US futures right now. This is the picture we find ourselves with. A little bit positive, but not by much, actually, this morning. You do feel as if we're searching for a catalyst first thing this morning. We didn't get really one out of Japan first thing. Japanese markets are also closed, Marine Day. But we've got an awful lot coming up. We've got the ECB this week, plus we're also counting down towards that tariff deadline as well. So plenty still to work our way through. But US futures at the moment, broadly positive after, I have to say, a very flat end to last week in terms of the Friday session. Up next, Danny Berger and The Brief. That's what you've got to look forward to. This is Bloomberg.